We are now officially in the Christmas season, holiday season, Hanukkah,
All the seasons. All right.
everything. Whatever you celebrate and celebrate
It's
it well.
happening this week. Yep. All the
This is
things.
Sunday. Well, for us, it's a little early this week.
It's
We had
early,
to do it
yeah.
because I'm going out of town to see some family, so we wanted to do it in the studio and not, we try to do it this way. It's always a
better
little
this
better,
way,
than to try to just, record some FaceTime video or whatever.
Yeah.
So hopefully you guys appreciate that. But we're not quite at Friday obviously not Friday closing. So if something crazy happens, which has already happened.
It's already happened this week.
So hopefully nothing else crazy happens, and we'll all be okay. But
Yeah.
we won't see you guys till after Christmas. So that's why I
right.
wanted to say happy holidays to everybody. Hope you're able to spend some time with loved ones. If you don't love them, pretend you do.
You're probably there anyway.
Pretend you do.
Oh boy, we got a lot of stuff to talk about
Let's
this
do it,
week. But before we get into the big elephant in the room, which was the market response to the Fed press conference on Wednesday, there's a couple of ways you can look at this, and it's a good chance to kind of do a little self-reflection. You can either look at, okay, the S&P was up 28% year-to-date on December 6th, and it was down 3% after that Fed meeting on Wednesday, right? So you can either say, okay, I've had some huge gains for the year. I'm feeling pretty good about that. Two consecutive 20+% annual returns for the S&P 500 C fund, and maybe last Wednesday was a rough day, but maybe it was a shot across the bow for things to come in 25. Maybe not, but maybe it's time to take a little bit off the table because we've had some big gains over the year. That's one way to look at it. The other way to look at it is to say, I'm fixated on the last most recent high, and that 3%. Well, it's actually more than 3% since December 6th, and therefore I'm down. I've lost 4%. So it's two different ways of looking at the world, and it will definitely drive how you manage through 2025. So not to say one's right or one's wrong, but just you should know which side of that fence you're on.
Say one of them's wrong.
Well, I know one of them's wrong, but I'm trying not to disappoint some people.
I'll play the devil's advocate here because you're right. There's going to be people that feel, that fall on the negative side. And if you take one thing from watching this show at all, forget about the charts, right?
What?
I mean, forget about them for a second, right? Just put that stuff aside. And when I say the charts, like exactly what's happening. Look, this is a long-term game. What you're trying to do is preserve capital, preserve wealth that you've built. You're trying to retire with some, with a good chunk of money in your TSP. If you don't look at a year like last year and this year and think, man, I've had a good year.
Yep.
And then, one day or 1 week, whatever it turns out to be for you, maybe you stay in and it goes down a little for whatever. But the point is, like, you had a good year. You still have a good year.
Yeah.
These are magnificent returns for something that is passive. You're not really doing anything. Yep. The market has been kind. Be happy.
Yeah.
If you're not willing to take money off the table because you got a gambling mentality, then you need to call that 1-800-GAMBLER line or whatever it is, because that's exactly what you're doing. If you're not looking at the last few days and at least taking something off the table to kind of minimize your risk in your retirement account, you're probably going about this all wrong. You really are, and it's not about it's not about fear. Right, it's a data-driven decision. Right. Jerry's going to give you all the data here in a minute. I know he is. Yeah. We're going to go through the charts. We're going to talk about what happened, and it's not just a matter of for what? Right. When I've had a good year, right. When I can just take my winnings and walk away.
I think people don't appreciate that the risk increases as the market increases and doesn't have a pullback.
Astronomically. The risk right now is as high as it can get, even
after this decline.
Because and I know you're going to get into this because we saw it. We talked about it in the charts, or you did in the analysis that you did. Yeah. But we're sitting at a few key positions right now where we got to wait and see what happens. And if you want to wait and see what happens in the market, go for it. But just know you're at risk. Yep. If you don't look at this as a risky time, and again, we're risk averse, but that's because it's a retirement account. Yep. This isn't a brokerage gambling account I'm using to go buy, things that are going to give me 300% returns and all this kind of crazy stuff. No, folks, this is not what that is. Yeah,
and to say I think a lot of people would agree with you that in general we're risk averse, but at the same time, if you were a subscriber to the site and you were following along for the year, I think at the end of November, we were up like 20%, and the S&P was up 25% or something like that. We were up 23. Yeah. It was S&P was 25. Like we were pretty close to being whatever the S&P was, a little bit below it. But so we're not riding the G fund while the market's going up. Is what I'm saying.
Well, we're risk averse based on data driven decisions. Is very different than risk averse based on fear.
Yeah, right.
That's a whole different thing, and I'm glad you pointed that out because that is not what I'm talking about. I'm not talking about being scared of losing our money. What I'm talking about is the charts, the data, the price action is telling us that there is massive risk right now. You can ignore that. That's fine. Your risk tolerance is different. Yep. We are trying to miss out those massive catastrophic losses. Yep. That's what we're really trying to miss. And so that's different than just losing 3% in 2 days. It's losing 3% and then looking across the board at all these other factors, that you're going to get into. I'm not going to stay here. I'm not going to we'll draw this out. You got to actually get into it. No,
it's okay. I'm not. If Conan's talking about an analysis that I did that we put out this morning to our subscribers.
But we're not getting into all of that. We're not getting into all of it. But generally, the principle applies where we didn't just look at what the S&P did, right? You look and see what the entire market is doing across the board. Factored in with some other things to say, okay, well, this is 1 or 2 days isn't a trend, so the trend hasn't changed. If you just look at the weekly chart for the S&P right now, you're still fine.
Yep, you're good.
It's getting a little sketchy, but you're still fine. But you're also at a high point of risk of it rolling over again, and it just sucks because you lose a lot of time by the noon rule, and so you can really gap down really quick and. We're just not in that business. We're going to try to miss those huge losses. All right, let's get into what you got.
We got a few things. So we'll talk about what happened this week macroeconomically, which none of it even compares to what happened on Wednesday. We'll talk a little bit about the Fed meeting and why it did what it did. Then Santa Claus Rally, which was supposed to be the key part of this podcast, but it's kind of we still might get a Santa Claus Rally. We're not quite in that window yet, and that'd be great if we do, but even that probably won't get us back up to new all-time highs. Mutual fund window. Haven't talked about that in a while, and we had a really great email from a subscriber there last week, and he was talking about some different options in the mutual fund window that he uses, and I know we've had questions in the group before about how to get more invested in like NVIDIA and Tesla and SpaceX and things like that. And this person found a couple of mutual funds that I think you guys will like, and we'll talk about that. This thing called the Hindenburg Omen, we talked about that a while ago, and it's an interesting chart as the bonus chart about that, and the TSP Fund Charts. And I have a wicked cold, so bear with me. All right, so Monday we got data for both New York Empire State Manufacturing Index and the global composite PMI shows manufacturing and services both kind of stable, right? Inflation falling a little bit from those metrics, and the S&P was up, 0.38%. That was on Monday. Tuesday, retail sales are up 0.7 month over month from 0.5 in October, right? So retail sales, that's good. Means holiday shopping is getting off to a pretty good start, but the S&P lost. It was down 0.39%, so basically flat for those 2 days. Then on Wednesday, we get the 30-year mortgage rate goes up, which shouldn't surprise anybody because the 10-year yield is going up. Mortgage rates went up to 6.75% from 6.67 last week. And new mortgage applications were down to negative 0.7% from having been positive 5.4 the week before. So that wasn't too good. Okay, then the Fed decision. right? At 2 o'clock, roughly, the S&P was like 6,050. I mean, virtually at all-time highs. And then as soon as Chairman Powell started talking, it started collapsing and was down about 3% for the day. We're going to get into that next slide. Thursday, GDP growth quarter over quarter was 3.1% versus 3% last month, so a little bit of an uptick in growth, which is good. Initial jobless claims were down, right? It was 220,000 versus 242,000 last week, and a forecast of 235,000. So that is saying that at least the most recent data is good for employment. Existing home sales were 4.15 million versus 3.96 million last month, and 3.83 million in September. So new or existing home sales have been improving since the September low, which is good. And then the S&P as of Thursday, late morning, was up 0.7, and tomorrow, Friday, core PCE, which is the Fed's preferred inflation metric, comes in, along with the Michigan consumer sentiment, and that could move prices on Friday. But definitely Wednesday was the big day. So Wednesday we had the last Fed meeting of 2024. The way it was described basically was a hawkish cut. So when the Fed is cutting rates, it's easing, okay, and that's dovish. But they're calling this a hawkish rate cut because while some stupid animal words, while they cut rates, right? Everybody expected them to cut rates by a quarter point, and that's what they did. But then they said that we're probably, because of all these different conditions, which come down basically to inflation and unemployment risk, because of these two conditions, where we have room to be flexible with whether or not we continue to cut rates. That statement sent everything into a tailspin. So the Fed's got maximum employment and stable prices. Those are the two mandates of the Fed. And they've been constantly saying that we're trying to get inflation down to 2%. So the problem is inflation is not really falling. It's pretty much stuck 2.5%, 2.75%, however you want to look at it, but it's basically stuck. And so if inflation is stuck, reducing rates makes inflation go up theoretically. And so why would you reduce rates, right? At the same time, so the worry about next year is that they can't continue to reduce rates because inflation is going to start turning back up. They're talking about some of the next administration policies would be inflationary, and there's a lot of risk about inflation going forward. So it was a head scratcher it's not a head scratcher. There were people that didn't think they were going to cut rates this time, but that would have been worse for the market. So that's on the one side. On the other side is unemployment. Unemployment has moved higher and is expected to continue to move higher, and unemployment is helped by decreasing rates. So the Fed has a problem, right? On the one hand, they have two responsibilities. One of them is to keep inflation low, and the other one is to keep unemployment low. And if they decrease rates, inflation goes up. So they've failed on that test. If they increase rates to keep inflation from going up, that hurts unemployment. So they're in a trick bag. And the market saw that as a problem, and the problem is that they're not going to be able to continue to lower rates. And going forward, we're going to be in this new kind of regime because the idea was that we're in a rate cutting environment now, having done a couple years of rate hiking. Now we're in a rate cutting environment, and everybody knows how to operate in a rate cutting environment. But with that press conference, everything changed because now we're not in a rate cutting environment anymore. He basically said we have room to pause or raise rates or whatever, depending on what we're going to be data dependent. And so we're in a new regime that people don't understand, and that's the repricing happened on Wednesday. and it can definitely continue. It's a whole new ball game right now. The expectation was 4 rate cuts in 2025, and now it's down to 1 or 2 is what the market thinks is going to happen. And so Wednesday was the worst market response to a Fed meeting day since March of 2020, which was when the Fed came out and cut rates at the beginning of COVID. So it's significant, and we'll see what happens. But that's what happened on Wednesday. All right, switching from that to woohoo Santa Claus Rally. So Santa Claus Rally, we kind of talk about this time every year. It's I got this from Wikipedia, so this is what the definition sort of it is. Santa Claus Rally is the sustained increase in the stock market that occurs around the Christmas holiday on December 25th. Most estimate these rallies happen in the week leading up to Christmas holiday, while others see the trend that begins Christmas and goes through the 2nd of January. The actual definition is it's the last 5 trading days of the year and the first 2 trading days of the following year. Theories that explain the Santa Claus Rally could include year-end tax considerations, a general feeling of optimism and seasonal happiness on Wall Street, and investing holiday bonuses. I think that whole section got taken away on Wednesday. Some institutional investors settle their books and vacation this time of year, leaving the market to retail investors like us, who tend to be more bullish toward the market. Santa Claus Rally is your end-of-year gift from the stock market most of the time. So it actually was coined by Yale Hirsch, was the founder of the Stock Traders Almanac, and he kind of saw the Santa Claus Rally thing in the market in 1972, and so he defines the time frame as the last 5 trading days of the year, the first 2 trading days of the following year. Those 7 days have historically shown higher stock prices, basically 80% of the time, right? Reflected in the S&P 500. So over that 7 trading day period, 80% of the time the market goes higher. Those are pretty good odds. Doesn't always happen, but 80% is pretty good. Stock Traders Almanac compiled data during the 73-year period from 1950 to 2022 and showed the Santa Claus Rally occurred 58 times, roughly 80%, with a growth in the S&P of 1.4%. So the average increase over that 7 trading day period is 1.4%. And the Santa Claus Rally is the beginning of this thing that's basically the triumvirate, right? You get the Santa Claus Rally going into the beginning of a new year. And then they have this idea of as goes the first week of January, so goes the month. So if January, the first week of January is a positive week, you expect the month of January to be positive. If the month of January is positive, you expect the year to be positive. So all 3 of these kind of work together. And the pullback we had this week actually doesn't enter into this triumvirate time period. So hopefully we'll still enjoy that. We shall see. All right. Mutual fund window. So we haven't talked about the mutual fund window, but I've seen a whole bunch of comments about it in the group, in the Facebook group. So, for anybody that doesn't know, these are the basics, right? Mutual fund window is an investment option. It got introduced a couple years ago, 2.5 years ago, when they redid the TSP site and had some new options and things, and one of them was the mutual fund window. So the idea is you can access a broader range of mutual funds beyond the core TSP funds. Okay, so the purpose of the mutual fund window allows participants to diversify their investments by choosing from a selection. It's basically 5,000 mutual funds, give or take, in the mutual fund window that are outside of the regular TSP options, which we know are the CSI, F&G funds. To be eligible, so the mutual fund window is like having a separate account within the TSP umbrella, okay? But it's completely separate. It's with the company is called A-Lite. You sign up for it within the TSP website, but it's literally a separate account. Participants must meet certain account balance requirements to use a mutual fund window. As of now, they typically need a minimum of $40,000 because you have to contribute at least $10,000 to open a mutual fund window account. And you can't contribute more than 25% of the value of your account. So if you have $40,000 in your TSP account, you would have to contribute $10,000 because that's the minimum you can have in the window, right? But if you have $1 million in your TSP account, the most you can contribute is $250,000. Okay, because you can only contribute 25% of your TSP account. And then if you're now you're running two accounts. Okay, if your mutual fund window grows faster than your TSP account grows, and your mutual fund window becomes more than 25% of the value of your core TSP, you can't contribute more into the mutual fund window. You can grow it and manage it like you would any account, but you can't add more money to it unless the value of your mutual fund window got below that 25% level. A lot of people get hung up on these fees. It's depending on how much you have in there. It's really not that big a deal. Administrative fees, one-time $55 annual fee to get in there. The maintenance fee is $95 a year. And then the big one that kind of annoys people is this $28.75 per trade. So when you buy it, when you buy a mutual fund, you're paying $28.75 to do it. And then when you sell it, you're paying $28.75 to sell it.
So almost $60
Yeah.
to make a full trade in and out. Yeah. That's one thing that I think a lot of people, again, this goes back to, and you can go back to our earlier videos. We've talked about the mutual fund a lot when it first came out.
Yep.
We haven't found it extremely useful unless you are diligent and have a lot of time to just manage that. And with that said, you still can't, yes, you can move more,
yep,
but you have to factor in the costs of those moves,
yep,
and how that's going to impact your overall return and your performance, and is it all worth it?
Yep.
Like at the end of the day,
all those things. Yep.
all those things. So you still have to look at it as sort of a, I won't say long term as in months and years, but if you're buying something to hold it for 2 days, you're in the wrong place.
Yeah, I mean it's not designed for that. Mutual funds aren't designed for that.
Exactly. And so even though you take away the moves, the restrictions, it's still not built to do. You want to be looking at investments that you want to be in for weeks, if not months.
Ideally, yeah.
That way, the trading costs, the overall fees in general, get outweighed by the performance,
Yep.
and then it actually pulls up your overall performance of your entire account.
Yep.
Because let's say you made 20% in the market in the regular TSP this year, and you up that to 30% or 25% by work you did in the
Mm-hmm.
mutual fund window. That's great. That's a great way to use it.
Yep.
But thinking about it as a way to kind of day trade.
Yeah, you can't day trade.
It's not possible.
It doesn't. It's mutual funds. It doesn't. It's way better than TSP. There's no noon rule.
Yeah.
There's no restriction on how many times a month you can move. But like you said, if you in and out of every trade is almost $60.
Yeah. And so you got to really pick your, just like you would. You only have 5 choices in the TSP. There you got, was it 5,000? So you got to narrow that down. There's a lot of work to be done. There are some folks out there that I think are trying to do services where they help you, look at the mutual fund window, kind of like we do the TSP. I haven't really, checked them out, so I'm not recommending it by any means. But there is something to be done with it. But you're really going to have to be on it.
Yep.
And that's just it's just a decision of if you barely have time to manage your TSP account, you don't have time to manage a mutual fund window.
No, I like the mutual fund window relative to the core TSP, but you're absolutely right. You have to put in the work, and so it's definitely not for everybody. But if you are interested, I kind of put together a little list of some themes. Right, and none of this is recommendations. It's themes. So, Bitcoin. Let's do Bitcoin first because everybody's talking about it. I liked Bitcoin, and I talked about it as a bonus chart. I don't know, a couple of months ago, basically because it was breaking out of a Elliott wave, a 5-wave pattern. It was breaking out of the 4-wave. And so I could easily project how high Bitcoin should go, and it was 100,000. It was what my projection is. And that's when I personally got into it in the mutual fund window, because I saw the breakout from this Elliott wave pattern. And I got out of it when it hit the extension of the Elliott wave pattern. I got out of it at 99,500 a couple weeks ago when it tagged 100,000. I'm like, that's it, I'm out, right? That's a much different thing than what we do with following the trend. And it was a several week, a couple of months maybe trade, but that's what you're trying to do in the mutual fund window.
Yeah, I mean, it's in essence a swing trade.
Swing trade. Yep.
And so that's one of the things that we're going to be talking about in our new courses that we're putting together, and is how you can use something like a swing trade sometimes to kind of do that. And we think it's definitely more useful in the mutual fund window than it is in the TSP account, but it's a tool.
It's a tool. Yeah. So all these are longs, right? So any of these, you can check them out in the mutual fund window. If you think oil and gas is going higher, there's something for you. If you're all into the dollar and interest rates, which if you're not, you should be, or at least understand how they work, you can essentially bet on whether you think the dollar is going to keep going up or the dollar is going to fall. If you really like the NASDAQ, there's one that's double the NASDAQ. So if the NASDAQ goes up 1% today, this fund theoretically goes up 2%. When commodities, not now, but when commodities bottom and start moving higher, that's going to be a great one. If you think dividends are the way to go, right, there's a good dividend appreciation fund. So there's a lot of different things. This was a really good one. It's better than the NASDAQ. It's just information technology, long-term government bonds. It's sort of like the TLT. It's a VLGSX. We've talked about it before. It's the mutual fund window version of the TLT. And in emerging markets, a lot of talk about emerging markets right now. There's not the China exclusion. The new iFund excludes China and all that. The mutual fund window does not have any of those rules. If you think that we're at a top, there's a whole bunch of ways that you can use the mutual fund window to make money on the way down if the market starts rolling over. I'm not recommending any of this stuff. I look at it all, and it's risky. I'm just telling you, it's risky. I had done this slide before Wednesday, and a lot of things have rolled over to include Tesla and NVIDIA, but these are the two mutual funds that the person that sent us that email was talking about. He's done really well on those two mutual funds over the past year or so. Obviously, Tesla is up big. SpaceX is now it's a private company, so it's really hard to get exposure to it. But this Barron Partners apparently has exposure to SpaceX somehow, and that's great. If you want to get some exposure to SpaceX, that's a way to do it. SMPIX is an ultra semiconductors. So semiconductors, the biggest piece of the semiconductor sector is NVIDIA. So if you're trying to get exposure to NVIDIA in the mutual fund window, that's a good way to do it. I forgot I had this slide. So Bitcoin, this also came up in the group. This is from it's from Yahoo Finance, but it's also in the prospectus. If you get BTCFX in the mutual fund window, they send you the prospectus, and it says the same thing in the prospectus. The fund seeks to achieve its investment objective primarily through managed exposure to Bitcoin futures contracts. It does not invest directly in Bitcoin. Okay, you cannot buy Bitcoin in the mutual fund window. The mutual fund itself does not own Bitcoin. It's managing futures contracts. Okay, the advisor expects to gain exposure by investing a portion of its assets in a wholly owned subsidiary of the fund organized under the law of the Cayman Islands and advised by pro-fund advisors. It is not diversified. So take that for the risk, that it is. It's a Cayman Islands fund. I wish I was down there living with them, the Caymans, trying to manage Bitcoin futures, but there's a lot of risk there, folks. Okay. Barron Partners, unfortunately, is not in stock charts, which is very annoying for me because I use TradingView and StockCharts.com as my charting software. TradingView does not do mutual funds, and StockCharts.com does almost all of them, but for whatever reason does not do BPTUX. So this is a chart from Yahoo Finance. It's pretty good. You can't really do too much with it, but as you can see, we are basically at the prior all-time high, and this is as of yesterday's close. Pretty big down day yesterday, but it's putting in a double top here. So if it can get above that line, it keeps going. If not, if we have a double top, it starts coming down. All right, and the other one was semiconductors. So SMPIX obviously is in stockcharts.com. Semiconductors have had a rough go of it for a while. You got a double top up here in the summer, a really big pullback, which was fine, but this does not look good. I mean, that's a pretty significant head and shoulders pattern. If we break down here to 42.50, let's say, it's going lower. Hopefully only down to maybe here, but we'll see. But the semiconductor sector is really not looking that good right now. But it has been great. So obviously huge percentage moves. Since this breakout here, it was 15, and up here it's 47, so it's tripled since this time last year. It's just that right now, it's not looking great. Okay, Hindenburg Omen. So we talked about this a while ago. Basically, what the Hindenburg Omen is when you have a lot of stocks in the New York Stock Exchange that are making new highs and a lot of stocks that are making new lows on the same day. Okay, there's a couple of other criteria in there, but those are the two big ones. You got a whole bunch of stocks making new highs and a whole bunch of stocks making new lows, and that happens on the same day. When that's what triggers the Hindenburg Omen. If you get two triggers in 1 month, basically 20 trading days, that is a giant red flag. Okay, so this is the S&P 500, daily chart of the S&P 500. This is the Hindenburg indicator. So here was right before COVID. We got a big cluster of Hindenburg Omen triggers right before COVID, and then we have COVID. Here's two triggers within that 20 trading day window right before the top in 2022. So the Hindenburg Omen isn't trying to catch these little moves. It's it's identifying long-term tops. Okay, so we have not had two triggers of the Hindenburg Omen in a 20-day period since the top in 2022 until this week. Okay, and this last one here was actually on Monday of this week. So it's kind of coincidental that we had this big, move down on Wednesday. But the bigger picture, the bigger takeaway from this is that it's identifying major tops. Okay, so is this going to be a major top? Don't know, but this is not. This is a big red flag for it. All right. TSP Fund Charts. So we do the weekly charts, right? This is as of the close on Wednesday. So by the end of the week, it's probably not going to look as bad. Maybe it could look worse. Who knows? But on a weekly basis, the trend, obviously since the bottom in October 2022, the trend is up. Okay? The blue line is the 20-week moving average line. We're still well above it. Usually we come down, we get support, and we keep on moving higher. And we can absolutely still do that this time. The trend can just continue to go higher. It's when it gets below this, it closes below that line that we have to really worry. Then we're looking at what happens on the recovery from there. Do we put in a lower high, and then the trend changes, and then that's when you start having a problem, right? You have a lower high, and then you get below the prior low. Now you have a new trend down. So it could be forming that, but we don't know yet. So on a weekly basis, there's really nothing to be too concerned about right now. We have had declining relative strength since, the top in July. So the markets have kept going up. The momentum behind that move has been consistently declining, which is telling us that eventually there's going to be a top, but you just don't know when. So when it gets below this 20-week moving average line and below 50 relative strength, that's a problem, right? You can see as long as the relative strength line is above the 50 line, price is going up. When relative strength is below the 50 line down here, price is going down. Okay, that's why these indicators work. All right, S Fund. We had been talking about this for a while. We finally got above the prior all-time high was back in late 2021, and we broke through there in October. Had a little pullback to kind of create the top of that channel line. We pulled back to the prior high, which was good. Kept on rallying. That was the election week, and then it rolled over. And so right now it's sitting more or less at the top of this channel. And then you also have the 20-week moving average line right there. So there's a lot of support right here for the S Fund. If we get below the bottom of this channel, that's a problem. Okay, there was a lot of support. Well, it was resistance at that point. Once it broke through, it became support here, which broke through, and then we had the down move. But we should not get below that line. If we do, that's kind of a structural problem for the S Fund. I Fund, we talked about for a long time. We had a triple top up here at 80 back in 2001. Market rolls over. We had a really good A, B, C. If you're a subscriber and you're looking at the newsletter this weekend, I kind of feel bad because I had already planned on doing this, but the projections, some of these ABC projections and the Fibonacci extensions were calling for a top, and it would have been good to know that last week, but it's the way it goes. iFund had fallen, right? It peaked in September. And we were talking about this for a while. The S and the C Fund had been rallying through September into December, right? The I Fund had been rolling over. That's called divergence. You cannot have the C and the S funds going up and the I Fund going down for very long. One of them is going to win out. Either the C and S are going to pull the I higher, or the I is going to pull the C and S down. And this is really ugly. If you're looking at this from an Elliott wave perspective, we peaked here. This is a one leg down, a two, and this huge gap down and move down. This is the beginning of a wave 3 down. So it's very possible on the iFund that we could be looking at, retesting that October low from last year. It also could turn around and go back up. It's just that the pattern is not great. Again, we're gonna talk about it in the newsletter this weekend, because the I Fund, if you look at this part of the I Fund, and then you go to the F Fund, it's the same chart. We peaked in September, pulled back, did a little recovery rally, and we're moving down, and we're just like in the I Fund, we're below this most recent low. And so what that is the I Fund goes down when the dollar goes up. The F Fund goes down when yield goes up. So we're in this rising dollar, rising yield environment. And that's how we're going into 2025. So we're going to talk about it in depth in the newsletter this weekend. If you're not a subscriber, go on ChatGPT or whatever and ask it what happens to the stock funds when the macroeconomic conditions are a rising dollar, rising yield. That's it. Questions?
I got lots of questions, but we don't have answers for them yet.
I cannot do jumping jacks fast enough to try to get out the word that 25 is not is absolutely not going to be 23 and 24. It's not. It's just not.
Yeah. It's going to be different. We just don't know what the different is going to look like. So you got to stay on top of it. You got to watch the show. You got to keep track of all this stuff because you're not going to hear about this stuff impacting TSP on Bloomberg or CNBC or anything else. So hope you guys like the show. If you do, share it with your friends. Start hitting that like button and the subscribe button. We don't say stuff like that a lot, but it does help our algorithm. Yep. And probably going to start saying that stuff in the beginning. But, do us a favor and subscribe if you do watch it regularly, and it helps us out. If you have any questions, you can send them to us in the comment section wherever you find the video. That way we know which video you're asking about. And if there's no video, you can shoot us a question at support@growmytsp.com.
Yep,
hope you guys have a great and safe holiday season, and we will see you just before the New Year's.
Awesome. Perfect.
All right. We're out of here.
Later.